Legal, regulatory, or contractual provisions often limit the useful life of an intangible asset, but on the other hand, useful life might sometimes be less than the asset's legal or contractual life. So, for example, the useful life of a patent would be considerably less than its legal life of 20 years if obsolescence were expected to limit the longevity of a protected product. The expected residual value of an intangible asset usually is zero. This might not be the case if at the end of its useful life to the reporting entity, the asset will benefit from another entity. So if Quadra Corp has a commitment from another company to purchase one of Quadra's patents at the end of its useful life at a determinable price, we use that price as the patent's residual value. The method of amortization should reflect the pattern of use of the asset in generating benefits. Most companies do use the straight line method. Intel Corporation reported several intangible assets in a recent balance sheet. A note shown in this slide disclosed the range of estimated useful lives. Like depletion, amortization expense traditionally is credited to the asset account itself rather than to an accumulated amortization. However, the use of a contra account is acceptable. Let's look at an example. Similar to depreciation, amortization is either a product cost or a period cost depending on the use of the asset. For intangibles used in the manufacture of a product, amortization is a product cost and is included in the cost of inventory and doesn't become an expense until the inventory is sold. For intangible assets not used in production, such as a franchise cost, periodic amortization is expensed in the period incurred. As you see here, Hollis Corporation began operations in 2018. Early in January, the company purchased a franchise from Ajax for $200,000. The franchise agreement is for a 10-year period. In addition, Hollins purchased a patent for $50,000. The remaining legal life of the patent is 13 years, but due to expected technological obsolescence, the company estimates that the useful life of the patent is only 8 years. So Hollins uses the straight line amortization method for all intangible assets. So as you see, the franchise amortization is the $200,000 over 10 years. The patent amortization is the useful life, which is going to be the $50,000 over 8 years. Intangible assets with an indefinite useful life are those with no foreseeable limit on the period of time over which the assets expected to contribute to the cash flows of the entity. So because of this indefinite life, these intangible assets are not subject to periodic amortization. Indefinite doesn't necessarily mean permanent. Suppose Collins Corporation acquired a trademark in conjunction with the acquisition of a tire company. Collins plans to continue to produce the line of tires marketed under the acquired company's trademark. Trademarks have a legal life of 10 years, but the registration can be renewed for an indefinite number of 10-year periods. The life of the purchased trademark is initially considered to be indefinite, and the cost of the trademark is not amortized. But if after several years management decides to phase out production of the tire line over the next 3 years, then Collins could amortize the remaining book value over that 3-year period. So IAS number 38 allows a company to value an intangible asset subsequent to initial valuation at cost less accumulated amortization or at fair value, if fair value can be determined by reference to an active market. But if revaluation is chosen, then all assets within that class of intangibles must be revalued on a regular basis. Goodwill, however, cannot be revalued. But GAAP, on the other hand, prohibits revaluation of any intangible asset. Let's look at a concept question. So, which of the following statements is true regarding the valuation of intangible assets? We know GAAP does not allow us to revalue at fair value for any of the intangible assets. So only in textbooks are property, plant, equipment, and intangible assets purchased and disposed of at the very beginning or very end of a company's fiscal year. When acquisition and disposal occur at other times, a company theoretically has to determine how much depreciation, depletion, and amortization to record for the part of the year that each asset actually is used. Partial year depreciation presents a problem only when time-based depreciation methods are used. In an activity-based method, the rate per unit of output simply is multiplied by the actual output for the period, regardless of the length of the period. Another common convention is to record 1/2 of a full year's depreciation in the year of acquisition and another half year in the year of disposal. This is known as half-year convention. So let's understand the partial period concept with the help of this slide. Partial year depreciation is recorded based on the number of months the asset's in service during a particular fiscal year. In this example, the asset was acquired during the year. On April 1st, the Hogan Manufacturing Company purchased a machine for $250,000. The company expects the service life of the machine to be 5 years and the anticipated residual value to be $40,000. The machine was disposed of after 5 years of use. The company's fiscal year-end is December 31st. So as you see here, in the 5th year, we will take the, for straight line, it will stay consistent. For some of the year digits, we will take 14,000, but double declining balance usually ends the depreciation prior to the asset being used. Now, Granite Enterprises acquired a patent from Southern Research Corporation on January 1st, 2018 for $3.2 million. The patent will be used for 5 years, even though its legal life is 20 years. Rocky Corporation has made a commitment to purchase the patent from Granite for $260,000 at the end of 5 years. Compute Granite's patent amortization for 2018, assuming the straight line method is used. So you see the $260,000 purchase commitment is treated as the residual value. So the $3.2 million minus the residual value of $260 divided by 5 years would provide amortization of $588,000 each year. Note that 2018 depreciation is 3/4 of the full year's depreciation for the first year of the asset's life. Because the asset was used 9 months or 3/4 of the year, the remaining 1/4 of the first year's depreciation is included in 2019's depreciation, along with 3/4 of the depreciation for the second year of the asset's life. This calculation is not necessary for the straight line method because a full year's depreciation is the same for each year of the asset's life. Usually, the procedure shown here is impractical or at least very cumbersome. So as a result, most companies adopt a simple assumption or convention for computing partial year's depreciation, and they use it consistently. As you see in this slide, this is a half-year convention. Let's look at another concept question. A machine is purchased on September 30th for $30,000. Useful life is estimated at 4 years. No residual value. The double declining balance method is used. The acquiring company's fiscal year ends on December 31st. So depreciation for 2019 should be $13,125. Basically, we have 3 months remaining in 2018 using double declining, which shows depreciation of $37.50. So what we'll need to do is take, for 2019, the $30,000 times 50% times 9/12, the remaining of the first full year of $11,250. So we need to take that $11,250 accumulated depreciation along with the previous year of $37.50. That totals $15,000. So for the depreciation remaining of 3 months, we take the cost of 30 minus the depreciation accumulated times 50% times 3 months out of 12 months, or $1,875. So our 2019 depreciation is the $11,250 plus the $1,875 to total our $13,125. We're going to now take a look at an extensive problem, 11.2. Hang in there with me, guys, and I got to bring this down a little. So, as you see, December 31st, 2017, Cord Company's plant, asset, and accumulated depreciation and amortization counts had balances as follows. So as you see, the land, $184,000, buildings, $1,950,000, with its corresponding accumulated depreciation of $337,900. Machinery and equipment, $1,575,000, with the accumulated of $326,500. Automobiles and trucks, $181,000, accumulated $109,325. And leasehold improvements of $234,000, with accumulated depreciation of $117,000. Now it tells us specifically how each of these categories are to be depreciated. Then it goes on to tell us depreciation's computed to the nearest month and residual values are immaterial, which means we're not going to deal with them. Transactions during 2018 include, on January 6, 2018, a plant facility consisting of land and building was acquired from King Corp in exchange for 34,000 shares of Chord's common stock. On this date, Chord stock had a fair value of $50 a share. Current assessed values of land and building for property tax purposes are $210,000 and $630,000 respectively. B. On March 25, 2018, new parking lots, streets, and sidewalks at the acquired plant facility were completed at a cost of $246,000. These expenditures have an estimated useful life of 12 years. C. The leasehold improvements were completed on December 31, 2014, and had an estimated useful life of 8 years. The related lease, which would terminate on December 31, 2020, was renewable for an additional 4-year term. On April 30th of 2018, Chord exercised the renewal option. D. On July 1st, 2018, machinery and equipment were purchased at a total invoice cost of $334,000. Additional cost of $10,000 for delivery and $59,000 for installation were incurred. Next, on August 30th, Chord purchased a new automobile for $13,400. F. On September 30th, a truck with a cost of $24,900 and a book value of $10,800 on date of sale was sold for $12,400. Depreciation for the 9 months ended September 30th was $2,430. Then G. On December 20th, a machine with a cost of $21,500 and a book value of $3,200 at date of disposition was scrapped without cash recovery. Our job is to prepare a schedule analyzing the changes in each of the plant's asset accounts during 2018. Do not analyze changes in accumulated depreciation or of amortization. So first, we're going to look at the balance of 2017, any changes, and the balance at the end of 2018. So the plant facility acquired from King on January 6th of 2018, allocation is to land and buildings. The fair value in exchange, remember there were 34,000 shares of common stock at $50 per share, gives us a value of $1,700,000. So in order to allocate that, the land of $210 and the building of $630 total $840,000. We allocate each asset to the whole, so we know out of the $1,700,000, 25% will go for land, 75% will go for the building. So our land has increased during the year, $425,000. It began at $184,000. That increase of $425,000 gives us an ending balance of $609,000 as of the end of 2018. The building of $1,275,000 is an increase for the year, with the balance as of the end of December 2017 of $1,950,000, we add the building, we have an ending balance here of $3,225,000. Now the machinery, the invoice cost of the machinery that was purchased in 2018 is $334,000, but when we add the delivery and the installation, we have a total machinery and equipment cost of $403,000. Now, as we look back or continue on, we need to see the depreciation for these various assets. The machinery depreciation is going to consist of the balance at the beginning of the year times 10%, straight line over 10 years, which would be at $157,500. But then we purchased the equipment that we just talked about, and that we are going to depreciate for half the year, 5%, $20,150, for a total depreciation for machinery and equipment for the year of $177,650. Now, in regards to the automobiles and trucks, we're going to look at the book value at the beginning of the year, take the 181 minus the accumulated depreciation to give us a adjusted balance of 71,675. Subtract that from the truck sold, gives us the amount that is available for depreciation, and this is utilized by the 150% declining balance rate. So if we depreciate this over 5 years, that would be 20%. But the 150 declining rate would take that 20% times 1.5, or 30%. So the 58,445 times 30% gives us 17,534. Then we need to look at the automobile purchased on August 30th. We're going to take that price of $13,400. 30% of that times 4/12, we have 4 months left in the year, is $1,340. The information at the beginning of the problem gave us the depreciation on the truck that was sold in September of $2,430. So if we take the 17,534, the 1340, and the 2430, we'll have a total here of 21,304 for depreciation in automobiles and trucks. Now, for the leasehold improvements, we're going to take the book value at the beginning of the year, 234, minus the 117 gives us 117,000. If we amortize it over 5 years, that gives us 23,400 each year. So as we go back, in this problem, we've calculated the depreciation for the various items that the land, the buildings, the machinery and truck equipment, automobiles and trucks, and leasehold improvements for a total depreciation for the year of $410,955. So, changes in estimates are accounted for prospectively. When a company revises a previous estimate based on new information, prior financial statements are not restated. Instead, the company incorporates the new estimate and any related accounting determinations from that point on. So it usually will affect some aspects of both the balance sheet and the other income statement in the current and future periods. A disclosure note should describe the effect of a change in estimate on net income and related per share amounts for the current period. So the asset's book value is depreciated down to the anticipated residual value of $22,000 at the end of the revised 8-year service life. In addition, a note discloses the effect of the change in estimate on income if it's material in nature. The before tax effect is an increase in income of $18,000, depreciation of $42,000 if the change had not been made, less $24,000 depreciation after the change. So let's just take a look at this problem here so we can go through it. On January 1st, the Hogan Manufacturing Company purchased office furniture and fixtures for $250,000. The company expects the service life of the office furniture and fixtures to be 5 years and the anticipated residual value to be $40,000. The company's fiscal year end is December 31st, and the straight line method depreciation is used for all depreciable assets. On January 1st of 2018, the company revised its estimate of service life from 5 to 8 years and also revised estimated residual value from $40,000 to $22,000. Depreciation for 2018 and subsequent years is recorded as follows. So we have our cost, we show our depreciation to date, which gives us the book value as of the beginning of the year. We revise our residual value to then get a revised depreciable base. From here, we change our estimated remaining life now, divided by 6 years. Since it was revised to 8, but we've already depreciated 2, we're going to take the 6, and our new annual depreciation now is $24,000. So let's look at a concept question here. On January 1st of 2018, the Esquire Corporation purchased equipment at a cost of $165,000. The equipment was expected to have a service life of 10 years and a $15,000 residual value. The straight-line depreciation method was used. In 2020, the estimate of residual value was revised from 15 down to 0, so depreciation then in 2020 should be what? Well, first of all, we need to take a look at how much depreciation we have already taken. So in this scenario, we were taking the $15,000 a year. Now, because we have revised the residual value to 0, we now are just using the $165 minus the 2 years of depreciation, we've already taken, which brings us down to 135. Divide that by 8 remaining years. So our new depreciation each year is $16,875. Peter's company purchased equipment on January 1st for $618,000. In June of in 2016 and 2017, Peters depreciated the asset on the straight-line basis with an estimated useful life of 8 years and a $6,000 residual value. But in 2018, due to changes in technology, Peter revised the useful life to a total of 4 years with no residual value. So what depreciation would Peters record for the year 2018 on this equipment? So as you can tell, what we're going to want to do is come up with what the new value is, the book value of $465. Since this life, $465 has the cost is $465, it's been changed to 4 years. So from what was remaining, we have 2 years left at this new depreciable cost. So the 465, divide that by 2, means we would record depreciation for the next 2 years of $232,500. Verizon Communications, Inc. recently revised its estimates of the service lives of certain property, plant, and equipment. So this slide here shows the note that disclosed the changes they were making. So as you see here, it tells us we changed the method of depreciation from straight line to units of production for the potash facility mining and milling assets beginning January of 2015, and the nitrogen and phosphate mining and plant assets beginning October of 2015. The change in method reflects anticipated changes to our production schedule due to facility expansions, volatility in market conditions, and the frequency and duration of plant turnarounds. So the current and expected reduction in depreciation expense is $30 million for 15 and $7 million for 2016. Generally accepted accounting principles require that a change in depreciation, amortization, or depletion method be considered a change in accounting estimate that is achieved by a change in accounting principle. We account for these changes prospectively, exactly as we would any other change in an estimate. One difference is that most changes in estimates do not require a company to justify the change. However, this change in estimate is a result of changing an accounting principle. Therefore, this requires a clear justification as to why the new method is preferable. So we are going to look at, in this scenario, a change in depreciation method for Hogan. We calculate depreciation for the years 16 and 17 under the double declining balance method. Now, the rate used for double declining balance method is calculated by doubling the straight line rate for 5 years, which is 40%. The depreciation in the year 2016 under the double declining balance method is calculated as $100,000, which is 40% of the cost of the asset of $250,000. The depreciation for the year 2017 is calculated as $60,000. This gives a total depreciation of $160,000 for 2 years. Next, we determine undepreciated cost at the beginning of 2018 to be $90,000. The difference between the cost of $250,000 and depreciation of $160,000 for the first 2 years. Then we deduct the residual value of $30,000 from the undepreciated cost at the beginning of 2018, which now gives us a depreciable basis of $60,000. This depreciable base of $60,000 is divided by the remaining life of 3 years to arrive at the new annual depreciation of $20,000. Agrium Inc. is a world leader in agricultural products and services. The company recently revised its depreciation method from straight line to units of production methods. This slide shows the note that disclosed this change. So here we have on January 1st, 2016, the Herald Company purchased equipment at a cost of $400,000. The equipment was expected to have a service life of 10 years and a $20,000 residual value. The company's fiscal year end is December 31st, and the double declining balance depreciation is used. But during 2018, the company switched from double declining to the straight line. So in 2018, the adjusting entry to depreciation expense is going to show $29,500. Basically, what we're going to do here is calculate the 16 and 2017 depreciation as of January of 2018. We have an undepreciated cost of $256 less our residual cost of $20 gives us a new base of $236,000 divided by 8 years gives us $29,500. Mason purchased equipment on January 1st, 2016 for $470,000, estimating a 4-year useful life with no residual value. In 2016 and 2017, Mason depreciated the asset using the sum of year digits. In 2018, Mason changed to straight line depreciation for the equipment. What depreciation would Mason record for the year 2018 on this equipment? So you can see depreciation using some of the years. 470 times 4/10 is 180. And then in 2017, 470 times 3/10 is 141. This leaves us with a book value of 141, which is the 470 minus the 329, so that the new depreciation is going to be 141 divided by 2 years remaining, which is the $70,500. Errors involving property, plant, and equipment and intangible assets include computational errors in the calculation of depreciation, depletion, amortization, and mistakes made in determining whether expenditures should be capitalized or expensed. These errors can affect many years. Here's a summary of the treatment of material errors occurring in a previous year. Previous year's financial statements are then retrospectively restated. Account balances are corrected. If retained earnings requires correction, the correction is reported as a prior period adjustment. And a note describes the nature of the error and the impact of the correction on income. So during the 2-year period, amortization expense was understated by $120,000, but other expenses were overstated by $300,000. So net income during the period was ultimately understated by $180,000. Of course, this is ignoring income taxes. This means that our retained earnings is currently understated by that amount. Patent is understated by $180,000. So the 2016 and 17 financial statements that were incorrect as a result of the error are retrospectively restated to report the addition to the patent and to reflect the correct amount of amortization expense, assuming both statements are reported again for comparative purposes in the 2018 annual report. Because retained earnings is one of the accounts incorrect as a result of the error, a correction to that account of $180,000 is reported as a prior period adjustment to the 2018 beginning retained earnings balance in Hathaway's comparative statements of stockholders' equity. Assuming that 2017 is included with 2018 in the comparative statements, a correction would be made to the 2017 beginning retained earnings balance as well. That prior period adjustment, though, would be for the pre-2017 difference, which is the $300,000 minus the $60,000 to equal $240,000. A disclosure note accompanying Hathaway's 2018 financial statements should describe the nature of the error and the impact of its correction on each year's net income, which is understated by $240,000 in 2016 and then overstated by $60,000 in 2017, along with earnings per share. So, a concept question for you. In 2019, the controller of the depot company discovered that 2018 depreciation expense was understated by $100,000, a material amount. Assuming an income tax rate of 40%, the prior period adjustment to 2019 beginning retained earnings would be a $60,000 debit. Since 2016 net income was overstated by $60,000, which caused the beginning of 2019 retained earnings to be overstated. So the adjustment decreases beginning rate retained earnings by the after-tax impact of the error. So let's take a look now at problem 1111 here. Collins Corporation purchased office equipment at the beginning of 2016 and capitalized a cost of $1,938,000. This cost figure included the following expenditures. So we see a purchase price of $1,790,000, freight charges of $24,000, installation charges of $14,000, an annual maintenance charge of $110,000, which totals the $1,938,000. Well, the company estimated an 8-year useful life for the equipment with no residual value. The double declining method was used. But in 2018, after the 2017 financial statements were issued, the company decided to switch to the straight-line depreciation method for its equipment. And at that time, the company's controller discovered that the original cost of the equipment incorrectly included 1 year of maintenance charges for the equipment. So as you see, ignoring income tax laws, prepare the appropriate correcting entry for the equipment capitalization error discovered in 2018. So we need to credit the equipment of $110,000. We're going to debit the retained earnings for $61,875 and debit our accumulated depreciation of $48,125. So the way in which we are handling this transaction is a result of adjusting various expenses, or going back and looking at what needs to be corrected. Depreciation expense during that 2-year period was overstated by $48,125. But other expenses were understated by $110,000. So the net income during the period that was overstated was the $61,875. So that's why the retained earnings is currently overstated by that amount. So as you see here with our analysis, we show the equipment new balance should be the $1,828,000. The maintenance for 1 year should have been an expense of $110,000. So then, as you see, the depreciation expense along with the accumulated depreciation for 2016 and 2017 shows the corrected numbers, and you see what we incorrectly showed as the depreciation expense in 2016 and in 2017. Now, ignoring income taxes, prepare journal entries showing the change in depreciation method. So our depreciation expense is now $171,375, and our accumulated depreciation is going to be that same amount. As you see here, the assets cost minus the depreciation accumulated to date gives us an undepreciated cost. With zero residual value, we then know the depreciable cost to be depreciated over 6 years, which gives us our $171,375. Depreciation, depletion, and amortization reflect a gradual consumption of the benefits inherent in property, plant, equipment, and intangible assets. An implicit assumption in allocating the cost of an asset over its useful life is that there has been no significant reduction in the anticipated total benefits or service potential of the asset. Situations can arise that cause a significant decline or impairment of those benefits or service potentials. An extreme case would be the destruction of a plant asset, like a building destroyed by fire, before the asset's fully depreciated. The remaining book value of the asset in that case should be written off as a loss. Sometimes the impairment of future value is more subtle. The way we recognize and measure an impairment loss differs depending on whether the assets are classified as held and used or held for sale. Accounting is different too for assets with finite lives than are those with indefinite lives. So an increasingly common occurrence in practice is the partial write-down of property, plant, and equipment and intangible assets that remain in use. For example, 2015, Murphy Oil Corporation recorded impairment charges of $2.4 billion. The charges reflect the decline in asset values associated with lower oil and gas prices. Now, conceptually, there's considerable merit for a policy requiring the write-down of an asset when there has been a significant decline in value. A write-down can provide important information about the future cash flows that a company can generate from using the asset. However, in practice, this process is very subjective. Even if it appears certain that significant impairment of value has occurred, it often is difficult to measure the amount of the required write-down. For assets to be held and used, different guidelines apply to property, plant, and equipment and intangible assets with finite useful lives that are subject to depreciation, depletion, or amortization, versus intangible assets with indefinite useful lives which are not subject to any type of amortization. Generally accepted accounting principles provide guidelines for when to recognize and how to measure impairment losses of long-lived tangible assets and intangible assets with finite useful lives. For purposes of this recognition and measurement, assets are grouped at the lowest level for which identifiable cash flows are largely independent of the cash flows of other assets. It would be impractical to test all assets or asset groups for impairment at the end of every reporting period. GAAP requires investigation of possible impairment only if events or changes in circumstances indicate that the book value of the assets or asset group may not be recoverable. This might happen from a significant decrease in market value, a significant adverse change in how the asset's being used or in its physical condition, a significant adverse change in legal factors or in the business climate, an accumulation of cost significantly higher than the amount originally expected for the acquisition or construction of an asset, a current period loss combined with a history of losses, or a projection of continuing losses associated with the asset, and a realization that the asset will be disposed of significantly below the end of its estimated useful life. So determining whether an impairment loss has occurred and for how much to record the loss, we have a two-step process. The first step is a recoverability test. An impairment loss occurs when the undiscounted sum of estimated future cash flows from an asset is less than the asset's book value. The measurement of an impairment loss. Step 2 is the difference between the asset's book value and the asset's fair value. If an impairment loss is recognized, the written down book value becomes the new cost base for future cost allocation. Later, recovery of an impairment loss is prohibited. Fair value is the amount at which the asset could be bought or sold in a current transaction between willing parties. Quoted market prices could be used if they're available. If fair value is not determinable, then it must be estimated. Keep in mind that we use undiscounted estimates of cash flows in step 1 to determine whether an impairment loss is indicated. But discounted estimates of cash flows often are used to estimate fair value to determine the amount of the loss. A disclosure note's needed to describe the impairment loss. The note should include a description of the impaired asset or asset group, the facts and circumstances leading to the impairment, the amount of the loss if not separately disclosed on the face of the income statement, and the method used to determine fair value. Changes in circumstances. So changes in a business climate related to a competitor's innovative products requires that Dakota investigate for possible impairment. Because the book value of $170 million exceeds the $150 million undiscounted future cash flows, an impairment loss is indicated. Now, step 2 is the measurement of the impairment loss. The impairment loss is $35 million, determined here. The entry to record the loss is shown here on this slide. Now, the loss normally is reported in the income statement as a separate component of operating expenses. You see here we reduce accumulated depreciation to 0 and decrease the cost base of the assets to their fair value of $135 million, which is going to be the 300 minus 165. The new book value of $135 million serves as the revised basis for subsequent depreciation over the remaining useful life of the assets, just as if the assets had been acquired on the impairment date for their fair values. Let's take a look at this concept question. Hallberg owns a factory for which it paid $270 million. At the end of 2018, the book value of the factory's assets totaled $189 million. Due to adverse economic conditions, Hallberg's management determined that it should assess whether an impairment loss should be recognized for the factory. The estimated undiscounted future cash flows to be provided by the factory total $180 million, and the factory's fair value at that point is estimated to be $120 million. Under these circumstances, Hallberg should A. record no impairment loss, B. would record a $9 million impairment loss, C. would record a $69 million impairment loss, or D. all of these are incorrect. So you see here the correct answer would be a $69 million impairment loss. Basically, the book value exceeds the undiscounted cash flow. So we know an impairment loss is indicated, step one. Then we look at the fair value, $120 million, is less than the book value of $189 million, thus showing a $69 million impairment loss. Macy's, Inc. is a department store chain providing brand name clothing, accessories, home furnishings, and housewares. Well, this slide shows the company's disclosure notes describing recent impairment losses. The notes also provide a summary of the process used to identify and measure impairment losses for property, plant, and equipment and finite life intangible assets. So I'm going to just read this. The carrying values of long-lived assets are periodically reviewed by the company whenever events or changes in circumstances indicate that the carrying value may not be recoverable, such as historical operating losses or plans to close stores before the end of their previously estimated useful lives. Additionally, on an annual basis, the recoverability of the carrying values of individual stores are evaluated. A potential impairment has occurred if projected future undiscounted cash flows are less than the carrying value of the assets. Well, the estimate of cash flows includes management's assumptions of cash inflows and outflows directly resulting from the use of those assets in operations. When a potential impairment has occurred, an impairment write-down is recorded if the carrying value of the long-lived asset exceeds its fair value. As a result of the company's projected undiscounted future cash flows related to certain store locations and other assets being less than their carrying value, the company recorded impairment charges, including properties that were the subject of announced store closings. The fair values of these assets were calculated based on the projected cash flows and an estimated risk-adjusted rate of return that would be used by market participants in valuing these assets or based on prices of similar assets. During 2015, long-lived assets held and used with a carrying value of $201 million were written down to their fair values of $53 million, resulting in an asset impairment charge of $148 million. So under U.S. GAAP, when events or changes in circumstances indicate that book value may not be recoverable, it should be treated and tested for impairment. Whereas under IFRS, assets must be assessed for indicators of impairment at the end of each reporting period. Indicators of impairment are similar to U.S. GAAP. Under U.S. GAAP, an impairment loss is required when an asset's book value exceeds the undiscounted sum of the asset's estimated future cash flows. Under IFRS, there is no equivalent recoverability test. An impairment loss is required when an asset's book value exceeds the higher of the asset's value in use, the present value of estimated future cash flows, and fair value less cost to sell. Under U.S. GAAP, the impairment loss is the difference between book value and fair value. Under IFRS, the impairment loss is the difference between book value and the recoverable amount, which is the higher of the asset's value in use and fair value less cost to sell. Then, with the subsequent reversal of loss, under GAAP it's prohibited, but under IFRS it's required if the circumstances that cause the impairment are resolved. Intangible assets with indefinite useful lives other than goodwill should be tested for impairment annually, and more frequently if events or changes in circumstances indicate that is more than likely than not that the asset is impaired. A company has the option of first undertaking a qualitative assessment. Companies selecting this option would evaluate relevant events and circumstances to determine whether it is more likely than not, which means a likelihood of more than 50%, that the fair value of the asset is less than its book value. Only if that's determined to be the case will the company perform the quantitative impairment test. The measurement of an impairment loss for indefinite life intangible assets other than goodwill is a one-step process. We compare the fair value of the asset with its book value. If book value exceeds fair value, an impairment loss is recognized for the difference. Notice that we omit the recoverability test with these assets because we anticipate cash flows to continue indefinitely. Recoverability is not a good indicator of impairment. Like property, plant, and equipment, and finite life intangible assets, if an impairment loss is recognized, then the written down book value becomes the new cost basis for future cost allocation. Recovery of the impairment loss is prohibited, and the disclosure requirements are also similar. So let's take a look at exercise 11:12. At the beginning of 2016, Metatic Inc. acquired Ellison Tech for $500 million. In addition to cash, receivables, and inventory, the following assets and their fair values were also acquired. So we have our plant and equipment of $140 million, patent of $30, and goodwill of $120. The plant and equipment are depreciated over a 10-year useful life on a straight line basis. There's no estimated residual value. The patent is estimated to have a 5-year useful life, no residual value, and is amortized using the straight line method. At the end of 2018, a change in business climate indicated to management that the assets of Ellison might be impaired. The following amounts have been determined. So the plant and equipment Undiscounted sum of future cash flows is $70 million. The fair value is $50. Patent, undiscounted sum of future cash flows $19. Fair value $12. Goodwill, the fair value of Ellison's Technology Corp. $340. Fair value of Ellison's net assets, excluding goodwill $290, and the book value of Ellison's net assets, including goodwill $370. So our job is to compute the book value of the plant, equipment, and patent at the end of 2018. So our plant and equipment would be a book value of 98. The patent should be a book value of 12. Basically here, we're going to figure out the depreciation to date on the plant and equipment. So we have our $140 million. Divide that by 10 years, gives us $14 million each year. We're into 3 years, so we're at $42 million. So the $140 million minus the $42 million accumulated depreciation puts our book value at $98 million. For the patent, the amortization to date, $30 million, divide that by 5 years, is $6 million a year. We're at 3 years, so we've got $30 million minus our $18 million gives us a book value with the patent of $12 million. Now, we're going to determine the amount of any impairment loss to be recorded, if any. So you see here, the plant and equipment will have a $48 million impairment loss, since the fair value of the equipment is at $50 million. Therefore, the book value of 98 minus the fair value would give us a $48 million impairment loss. Now, with the patent, there is no impairment loss because the undiscounted sum of future cash flows of $19 million exceeds our book value of $12 million. Next, with goodwill, an impairment loss is indicated because the book value of the assets of the reporting unit, $370 million, is greater than the $340 million fair value of the reporting unit. So, the amount of the impairment loss is determined by the fair value of Ellison's Technology $340 less the fair value of Ellison's net assets, excluding goodwill, $290, shows an implied fair value of goodwill should be $50. Right now we have the book value of goodwill to be $120. That less the implied fair value of goodwill of $50 would give us an impairment loss of $70 million. So, similar to U.S. GAAP, IFRS requires indefinite life intangible assets other than goodwill to be tested for impairment at least annually. Under GAAP, a company has the option to avoid annual testing by making qualitative evaluations of the likelihood of asset impairment. Under GAAP, the impairment loss is measured as the difference between book value and the fair value, while under IFRS, the impairment loss is the difference between book value and the recoverable amount. The recoverable amount is the higher of fair value less cost to sell and value in use, which is the present value of the estimated future cash flows. IFRS requires the reversal of an impairment loss if the circumstances that cause the impairment loss are resolved. Reversals, again, are prohibited under GAAP. Indefinite life intangible assets may not be combined with other indefinite life intangible assets for the required annual impairment test. Under GAAP, in certain criteria, if they're met, indefinite life intangible assets can be combined for the required annual impairment test. Guys, I'm going to stop right here and finish up this lecture, and you will see me back with the part 3 lecture as we finish chapter 11.